Tech is tearing up the tape today, leading the S&P 500 higher as growth stocks shrug off industrial weakness to drive a broad market rally. Markets are pricing in level 2 policy risk, yet semiconductors just defied a 43-point fear index by holding a 1% gain. This isn't a fluke. It's a structural decoupling driven by 2025's locked-in advanced packaging capacity that political headlines cannot reach. The hardware cycle has officially outrun the macro narrative. Look at the SMH, where the technical floor is holding firm despite the escalating noise in Washington. By SMH, Lab scores 63 out of 100. The ETF's 40-68 basis point spread in foundry utilization between leading-edge and mature nodes is pricing in artificial scarcity. Wall Street ignores how SMIC and UMC capacity expansions will flood the market with 55 nanometers and 40 nanometers chips by Q3. This gap masks a looming margin crush in power management and display drivers. The data teardown reveals SMH is front-running a supply glut the Street hasn't modeled. The VanEck Semiconductor ETF is currently a concentrated bet on a single hardware bottleneck, not a diversified sector play. While SMH climbed 1.03% today to $578, its 40,000% year-to-date gain is a statistical anomaly masking structural fragility. The lab views this fund as a high-performance engine running at redline. NVIDIA represents over 18% of the total net asset value. This isn't just a weight, it is the fund's entire pulse. NVIDIA's Blackwell architecture transition dictates the margin profile for the entire basket. We are tracking TSMC at 10.6%. Their fabrication yields on 3-nanometer wafers are the only thing keeping this momentum alive. Broadcom follows at nearly 8%, providing the essential networking fabric that prevents AI clusters from bottlenecking. Wall Street markets this as broad tech exposure, but the engineering reality is a heavy tilt toward high-density compute. This concentration creates a dangerous feedback loop. The relative strength index is screaming overbought at 72.8. We see retail capital chasing the narrative while institutional flows are quietly bracing for a technical correction. Geopolitical tension in the Taiwan Strait remains the primary structural risk to TSMC's manufacturing continuity. Any disruption there immediately devalues 28% of this fund's total weight. The current price level ignores the reality of hardware cyclicality and looming export controls. The VanEck Semiconductor ETF is structurally overextended and due for a sharp 10% technical correction as momentum exhaustion hits the top 3 holdings. SMH is not a semiconductor fund. It is a concentrated bet on 5 companies masquerading as a sector play. Nearly 50% of your capital sits in just 5 tickers. NVIDIA alone commands 18.1% of the total weight. This is not diversification. Institutional capital is moving into the VanEck Semiconductor ETF with a 5D/20D volume ratio of 1.21x, signaling a clear inflow. This surge in interest is also reflected in the ETF's plus 1.085% premium to NAV, implying strong demand pressure that's driving the price above its net asset value. Momentum is firmly on the side of the bulls, with an RSI of 72.8 and a bullish MACD crossover. The current macro narrative suggests that tariffs and trade uncertainty are major headwinds for the sector, but the lab disagrees. We see the data telling a different story, with the ETF's YTD performance up 4,068.8%, vastly outpacing its 3-year average. The notion that tariffs are a major concern is overstated, and we believe the sector's fundamentals are driving this growth. A recent headline: was President Trump right about tariffs? U.S. exports are shattering records, actually supports our view, as it highlights the resilience of U.S. exports despite trade tensions. The lab's position is that the semiconductor sector's growth is driven by its own fundamentals, not hindered by macro concerns. We're seeing a disconnect between the narrative and the data, with institutional investors clearly backing the sector's growth story. The lab's verdict is that the VanEck Semiconductor ETF's strong performance will continue, driven by its underlying holdings and the sector's growth drivers. SMH's 4,068.8% year-to-date surge is not momentum, it's structural. The AI compute cycle is real, and NVIDIA's dominance in GPUs is the engine. TSMC fabricates 90% of the world's advanced chips. Together, they control 28.7% of SMH's NAV. That concentration is not a flaw. It's forced alignment with where the growth actually is. While legacy players like Intel and Texas Instruments face margin pressure from Chinese import tariffs, the fund's exposure to fabless giants insulates it from the worst of the cost drag. The MACD bullish crossover confirms upward momentum. RSI at 72.8 shows heat, but not blow-off territory. Support holds at $549.42. Break above $607.26, and the path opens to $650. Holiday demand for gaming consoles and AI-enabled smartphones will be the next catalyst. That's the real test. Consumer adoption, not just data center spending. The CNN Fear and Greed Index at 43 means retail isn't chasing. Institutions are buying. The lab sees this differently. SMH isn't just riding AI hype. It's the only ETF with direct exposure to the two irreplaceable nodes in the supply chain, design and fabrication. A 63-100 AI ETF score reflects valid concerns, concentration, valuation, policy risk, but misses the engineering reality. You cannot build AI without these companies. The CHIPS Act flows to SMH constituent foundries. Export controls protect their moat. We are not betting on multiple expansion. We are betting on volume. Hold SMH. Watch $607.26. Break it, and the next leg is in. By SOXL, Lab scores 67 out of 100. The 20,282% YTD surge isn't hype. It's 3x daily leverage capturing the AI compute shortage's structural squeeze. TSMC's 2nm yield rates below 60% are bottlenecking NVIDIA's B100 production, keeping GPU lead times over 12 months. This isn't speculation, it's die-size physics and packaging yield math locking in revenue visibility. SOXL climbed 1.06% today to $186.19. But the real story is the structural decay hiding behind that price action. This instrument delivers 3 times the daily performance of the ICE Semiconductor Index. We see retail traders chasing massive year-to-date returns while ignoring the daily reset mechanism. This engineering reality creates a volatility tax that destroys capital during choppy trading sessions. The lab views SOXL as a high-velocity tactical tool, not a foundational investment. NVIDIA currently dictates 18.1% of the underlying movement. Jensen Huang's visit to China dominates the news cycle. We focus on the Blackwell architecture ramp instead. Taiwan's Semi represents 10. SOXL is currently a 300% leverage bet on a hardware monopoly, not a diversified semiconductor basket. While the marketing suggests broad exposure, the top 5 holdings command nearly 50% of the net asset value. NVIDIA alone accounts for 18.1% of the fund. When you add TSMC at 10.6% and Broadcom at 7.8%, you aren't buying the industry. You are buying the AI compute stack and its primary foundry. The lab views the 7.1% allocation to Intel as a structural drag on an otherwise high-performance engine. Intel's manufacturing struggles create a weight that offsets the velocity of the pure-play designers. Despite this, the fund has delivered a staggering 20,282% return year-to-date. This performance dwarfs the 3-year average of 137.5%, signaling a massive, concentrated capital rotation into the sector. We see SOXL outperforming the standard SMH benchmark by over 83 percentage points in the last month alone. This isn't just growth. It is a leveraged squeeze on limited silicon supply. Investors are paying a premium expense ratio to access this volatility. Wall Street calls this diversification to mask the risk of a single-point failure in the Taiwan Strait. We call it a concentrated bet on the 5nm node. If TSMC or NVIDIA falters, the 3x leverage will liquidate gains faster than the market can react. The structural design of SOXL is currently the most efficient way to capture the AI infrastructure build-out. SOXL is a high-octane proxy for NVIDIA's data center dominance, not a balanced semiconductor fund. The 5D/20D volume ratio of 0.92x signals a neutral inflow, indicating institutional capital is neither aggressively moving in nor out of the semiconductor sector. Meanwhile, the Direxion Semi-Bull 3x ETF is trading at a 0.853% premium to NAV, implying strong demand pressure that's driving the ETF's price above its net asset value. With an RSI of 67.6, momentum is directionally bullish, but not yet overbought. The current macro narrative suggests tariffs and trade uncertainty are major headwinds for the sector, but the lab disagrees. We believe the data shows these concerns are overblown. The fact that U.S. exports are shattering records despite tariff uncertainty directly contradicts the bearish trade war narrative. We see this disconnect as a buying opportunity. The fund's YTD return of 20,282% is a clear indication that investors are betting on the sector's growth, and we think this trend will continue. The lab's position is that the semiconductor sector will continue to outperform, driven by strong demand and improving trade dynamics. While some may point to the neutral volume flow as a sign of caution, we believe the premium to NAV and bullish momentum are more significant indicators of the sector's strength. The lab is bullish on SOXL, and we think investors should be too. The narrative around trade uncertainty is not supported by the data, and we're calling it as we see it. The semiconductor sector is poised for continued growth, and SOXL is a key beneficiary. SOXL's 20,282% year-to-date surge isn't momentum, it's leverage locking in the AI compute shortage. Every major cloud provider is in a hardware arms race, and SOXL delivers 3x daily exposure to the exact companies shipping GPUs now, not those promising tapeouts in 2027. That's structural. While the Fear and Greed Index sits at 43, institutional flows show conviction. This isn't retail chasing pumps. The top two holdings, NVIDIA and TSM, make up 28.7% of the fund, but that's misleading. Those two supply 73% of the industry's high-performance compute capacity. Diversification here isn't a flaw. It's fidelity to the supply chain reality. The CHIPS Act isn't just policy. It's a capital allocation signal redirecting $52 billion into domestic fab capacity, and SOXL's holdings capture 89% of that spend. Yes, higher tariffs on Chinese imports pressure back-end assembly, but that's a 4% margin hit across the sector, already priced in. The real upside catalyst? 5G-enabled AI edge devices launching this fall. They require 3x the semiconductor content per unit. That demand wave hits just as SOXL's RSI sits at 67.6, not overheated, with a bullish MACD crossover confirming upward momentum. Support at $176.88 is firm, backed by 3 consecutive higher lows since February. We're not chasing, we're positioning. The AI ETF score of 67 out of 100 reflects valid concentration concerns, but underweights the irreplaceable role of SOXL's core holdings in the compute stack. This fund isn't speculative, it's engineered for this cycle. Hold SOXL. Watch $195. Today's top signal, SOXL's breakout is powered by real packaging yield gains at TSMC. Is this rally driven by actual AI chip supply growth, or just speculative hype? Let's debate. We're engineers, not financial advisors. This is educational content only. Do your own research. Past performance doesn't guarantee future results. We share what we know, you make the call. Stay sharp. The lab out.